Concepts of IAS 8. IAS 8, or International Accounting Standard 8, is a crucial standard that guides financial reporting, emphasizing transparency and consistency. Let me break down the key concepts. 1. Accounting policies. Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. They are essential for providing a framework for the preparation of financial statements and ensuring uniformity in reporting. 2. Accounting estimates. Accounting estimates involve approximations of the financial statement elements, such as depreciation, provisions for bad debts, or the useful life of an asset. These estimates are based on the best available information at the time and may be subject to revisions as new information becomes available. 3. Changes in accounting policies. Changes in accounting policies are adjustments made by an entity to its accounting principles. These changes can be voluntary or may be necessitated by changes in accounting standards. IAS 8 prescribes that changes in accounting policies should be applied retrospectively unless impracticable, and disclosure of the nature, reasons, and impact of the change is required. 4. Changes in accounting estimates. Changes in accounting estimates result from new information or developments affecting estimates used in prior periods. Unlike changes in accounting policies, changes in estimates are applied prospectively. For example, a company might revise its provision for doubtful debts based on updated information about customer creditworthiness. In summary, IAS 8 ensures that financial statements are prepared using consistent accounting policies and estimates. Changes in policies are applied retrospectively for comparability, while changes in estimates are applied prospectively to reflect the evolving nature of business circumstances. This standard plays a vital role in maintaining the reliability and relevance of financial information for users of financial statements. Accounting policies and accounting estimates. Accounting policies and accounting estimates are distinct components in financial reporting, each serving a specific purpose. Let me break down the differences with examples. 1. Accounting policies. Definition. Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. Example. Consider a company that adopts the straight-line depreciation method for its tangible assets. This is an accounting policy choice. Another company might choose the double declining balance method. These policies guide how the company recognizes and records depreciation expenses. 2. Accounting estimates. Definition. Accounting estimates are approximations of the financial statement elements, and they involve judgment and uncertainties. Example. Let's say a company has accounts receivable, and it estimates a provision for doubtful debts based on historical data and current economic conditions. The amount of this provision is an accounting estimate because it involves subjective judgment about the collectibility of specific receivables. In summary, accounting policies provide the framework for how transactions are recorded and reported, while accounting estimates involve making informed approximations about certain financial values. The choice of an accounting policy remains relatively stable, whereas estimates may need adjustments based on new information or changing circumstances. Changes in accounting policies and changes in accounting estimates. Firstly, a change in accounting policy arises when there is an adoption of a new accounting principle or a different method of applying an existing principle. This change is usually made to enhance the relevance and reliability of financial information and is typically applied retrospectively. On the other hand, a change in accounting estimate occurs when there is a revision in the estimation technique used to assess the carrying amount of assets and liabilities. This could include changes in the useful life of an asset, a revision in the residual value, or adjustments to provisions for doubtful debts. Importantly, changes in accounting estimates are generally applied prospectively. The key criteria for distinguishing between the two are the nature and impact of the change. If the change affects the recognition, measurement, or presentation of items in the financial statements, it is likely a change in accounting policy. Conversely, if the change only adjusts the carrying amount of assets and liabilities based on new information, it is considered a change in accounting estimate. Let's say a company decides to switch from FIFO to weighted average cost for valuing its inventory. This would be considered a change in accounting policy as it alters the fundamental measurement basis. Conversely, revising the estimated remaining useful life of a machine based on a recent inspection would be a change in accounting estimate due to new information. In summary, the primary factors for determining whether a change in accounting treatment constitutes a change in accounting policy or a change in accounting estimate involve assessing the nature of the change and its impact on the financial statements. Understanding these criteria helps ensure proper application of accounting standards and maintains the consistency and comparability of financial information over time. Disclosure requirements for accounting policies and changes in accounting policies and estimates under IAS 8. In accordance with IAS 8, entities are required to provide comprehensive disclosures regarding their accounting policies and any changes therein. The primary objective is to ensure transparency, comparability, and a clear understanding of the financial statements by users. Let me outline the key disclosure requirements. 1. Accounting policies. Entities are required to disclose their significant accounting policies and any changes in those policies that have had a material impact on the financial statements. The nature and justification for selecting particular accounting policies, especially if they deviate from the standard, should be clearly communicated. These disclosures enable users to understand the basis on which financial statements are prepared and to assess the impact of different accounting policies on the reported results. 2. Changes in accounting policies. When there is a change in accounting policy that is applied retrospectively, entities must disclose the nature of the change and the reasons for making it. The effect of the change on the current period and any prior periods, if practicable, should be quantified and presented. If it is impracticable to apply the new policy retrospectively, the entity should disclose that fact, along with the reasons for the impracticability. 3. Changes in accounting estimates. Entities should disclose changes in accounting estimates if they have a material effect on the financial statements. Disclosures should include the nature and amount of the change, as well as the reasons for the change. Changes in accounting estimates are applied prospectively from the current period unless the change also affects prior periods, in which case, appropriate adjustments are made to prior periods. 4. Correction of errors. When errors are corrected retrospectively, entities need to disclose the nature of the error, the impact on the financial statements, and the reasons for the correction. If it is impracticable to correct the error retrospectively, entities should disclose that fact and provide information about how the error has been corrected. 5. Materiality considerations. IAS 8 emphasizes the importance of materiality in these disclosures. If a change or correction is immaterial, it may not require separate disclosure. However, the materiality threshold should be determined in the context of the financial statements as a whole. In summary, these disclosure requirements aim to provide users with a clear understanding of accounting policies, changes therein, and changes in accounting estimates. ensuring that financial statements are both reliable and relevant for decision-making. Scenario where a company decides to change its accounting policy for depreciation under IAS 8. ABC Company has been using the straight-line method for depreciating its machinery for several years. However, due to technological advancements and a reassessment of the machinery's useful life, the company decides to switch to the units of production method. Steps involved in applying IAS 8. 1. Identification of the need for a change. The company identifies the need for a change in its accounting policy for depreciation based on a reassessment of the machinery's useful life and the desire to better align the depreciation charge with actual usage. 2. Assessment of materiality. ABC Company assesses the materiality of the change to ensure compliance with IAS 8. If the change is material, the company proceeds with the retrospective application, otherwise, it may consider the change prospective. 3. Determination of the new accounting policy. The company decides to adopt the units of production method for depreciating machinery, which is a more accurate reflection of the asset's consumption pattern. 4. Restatement of opening balances. For the earliest prior period presented in the financial statements, ABC Company adjusts the opening balances of affected assets, liabilities, and equity to reflect the new accounting policy. This involves restating the accumulated depreciation and carrying amount of the machinery. 5. Calculation of the adjustments. The adjustment is calculated by comparing the depreciation expense under the previous policy with what it would have been under the new policy. The difference is recognized as an adjustment to the opening balances. 6. Presentation in the financial statements. ABC Company discloses the nature and amount of the change in accounting policy for depreciation in the financial statements. This includes providing details on the reasons for the change and the impact on the financial statements. 7. Impact on the financial statements. Income statement. The depreciation expense for the current year will differ from what it would have been under the previous policy. This change affects the net profit for the current period. Balance sheet. The carrying amount of the machinery on the balance sheet will be adjusted to reflect the new depreciation charges. Accumulated depreciation will also be restated. Cash flow statement. Cash flows related to depreciation in the operating activities section will be impacted by the change in the depreciation policy. Conclusion. Through the application of IAS 8, ABC Company ensures consistency and comparability in its financial statements. The disclosure of the change in accounting policy provides transparency to stakeholders, allowing them to understand the reasons for the change and assess the impact on the company's financial performance. Challenges of distinguishing between changes in accounting policies and changes in accounting estimates. The challenges of distinguishing between changes in accounting policies and changes in accounting estimates arise from the intricacies involved in the financial reporting process. Let me break down some of the key challenges. Firstly, changes in accounting policies involve alterations in the principles and methods used to prepare financial statements. These changes often have a pervasive effect on the recognition, measurement, presentation, or disclosure of transactions and events. On the other hand, changes in accounting estimates are adjustments to the estimated amounts reported in the financial statements, and they usually result from new information or developments. One challenge is that the line between policies and estimates can sometimes blur. For instance, a change in the useful life of a depreciable asset can be viewed as both a change in accounting policy and a change in estimate, as it reflects new information about the asset's longevity. Therefore, determining the primary nature of the change becomes crucial. Another challenge lies in the subjectivity inherent in estimates. Accounting estimates involve judgment, and as new information becomes available, there may be a need to revise these estimates. However, distinguishing between changes due to new information and changes resulting from a change in policy can be complex. Deciphering whether the adjustment is a correction of an error or a change in estimate requires a thorough understanding of the underlying circumstances. Moreover, the impact of changes in accounting policies and estimates on financial statements may not always be immediately apparent. The retrospective application of changes in policies and estimates involves restating prior periods, and this can be resource-intensive and complex, especially when dealing with historical data. In conclusion, the challenges in distinguishing between changes in accounting policies and changes in accounting estimates underscore the importance of clear communication and transparency in financial reporting. Entities need to provide detailed disclosures explaining the nature of the changes, the reasons behind them, and their impact on the financial statements. This transparency is crucial for users of financial statements to comprehend and evaluate the implications of these changes on the entity's financial performance and position. Relationship between IAS 8 and other relevant accounting standards, such as IAS 1 or IAS 16. IAS 8 plays a crucial role in ensuring consistency and comparability in financial reporting. When applied in conjunction with IAS 1, which sets out the principles for the presentation of financial statements, it helps in providing a clear and transparent picture of an entity's financial performance and position. For instance, when a company decides to change an accounting policy, as per IAS 8, the impact of this change needs to be disclosed in the financial statements. This disclosure, in turn, aligns with the requirements of IAS 1, which emphasizes the importance of presenting a comprehensive set of financial statements, including all material information. Moreover, when it comes to tangible assets covered by IAS 16, such as property, plant, and equipment, IAS 8 is particularly relevant. If there is a change in an accounting estimate related to, say, the useful life of machinery, this adjustment could have implications on the depreciation expense reported under IAS 16. The retrospective application of such changes ensures that historical financial statements are restated, maintaining consistency. In summary, the relationship between IAS 8, IAS 1, and IAS 16 lies in their collaborative contribution to the quality and reliability of financial reporting. IAS 8 guides the treatment of accounting policies and changes in estimates, ensuring that these changes are transparently presented in the financial statements according to the principles outlined in IAS 1, while also influencing the values reported under other standards like IAS 16 for property, plant, and equipment. Real case study where you had to deal with a change in accounting policies or estimates. Explain your reasoning and decision-making process. In my previous role as a financial analyst at XYZ Corporation, we encountered a situation that required a change in accounting estimate related to the useful life of certain production equipment. The company historically used a straight-line depreciation method with an estimated useful life of 10 years for these assets. However, as part of our regular review process, we identified that technological advancements had significantly reduced the practical utility of the equipment, making it more reasonable to revise the estimated useful life. The decision-making process involved the following steps. 1. Identification of the issue. We regularly conducted reviews of our fixed assets to ensure their carrying values accurately reflected their economic benefits. During one such review, we noticed that the production equipment's performance had been affected by technological changes, making the original estimate of a 10-year useful life seem overstated. 2. Gathering relevant information. We gathered data on the equipment's recent performance, maintenance records, and consulted with the production team to understand any observed changes in efficiency. Additionally, we researched industry trends and benchmarked our useful life assumptions against industry standards. 3. Engagement with stakeholders. We engaged in discussions with key stakeholders, including the production team, finance department, and external auditors. Their input was valuable in assessing the impact of the change on financial statements, as well as understanding any operational considerations. 4. Assessment of materiality. We assessed the materiality of the change, considering both quantitative and qualitative factors. This involved evaluating the impact on depreciation expenses, financial ratios, and the overall financial health of the company. 5. Documentation and communication. We documented the entire process, including the rationale behind the change, supporting evidence, and discussions with stakeholders. Clear communication was essential, and we prepared a summary report outlining the proposed change, its justifications, and the expected impact on financial statements. 6. Implementation. After receiving approval from senior management, we implemented the change retrospectively in accordance with IAS 8. This involved restating prior financial statements to reflect the revised useful life and adjusting depreciation expenses accordingly. 7. Continuous monitoring. Post-implementation, we continued to monitor the equipment's performance and regularly reviewed the accounting estimate to ensure it remained relevant. This aligns with the principle of continuous improvement and adaptation to changing circumstances. Non-compliance with IAS 8 in a sample financial statement disclosure and suggest solutions. In reviewing the financial statement disclosure regarding the change in accounting policy for depreciation, I've identified a potential area of non-compliance with IAS 8. The standard generally requires retrospective application of changes in accounting policies, unless it's impracticable or the standard specifically allows prospective application. In this case, the company has applied the change prospectively, which may not align with the retrospective application principle outlined in IAS 8. To ensure compliance, a solution would be to retrospectively adjust the opening balances of assets, liabilities, and equity for the earliest prior period presented. This means restating the comparative financial statements to reflect the impact of the change in the depreciation policy. Additionally, the disclosure should provide a clear explanation of the nature of the change, the reasons for the change, and the quantified effect on the affected line items in the financial statements. This would enhance transparency and help stakeholders better understand the implications of the change. Moreover, it's essential to evaluate the materiality of the change. If the impact is immaterial, the company may consider whether retrospective application is still necessary or if a prospective application is appropriate based on the specific circumstances. In summary, my recommendation to address this potential non-compliance would be to revise the financial statement disclosure to reflect the retrospective application of the change in accounting policy for depreciation, provide a comprehensive explanation, and assess the materiality of the impact on the financial statements. Improve the internal controls over accounting policies and estimates to ensure accurate and consistent application. I believe there are several ways to enhance internal controls over accounting policies and estimates, ensuring accurate and consistent application. Firstly, implementing a comprehensive and regularly updated accounting policies manual can serve as a centralized source for all employees. This manual should clearly outline the company's accounting policies, including guidelines for estimates and the rationale behind them. Regular training sessions for finance and accounting teams can further reinforce understanding and adherence to established policies. These sessions can also cover any updates or changes to accounting standards, ensuring that all team members are aware of the latest developments. To enhance oversight, periodic internal audits specifically focused on the application of accounting policies and estimates can be conducted. These audits can identify areas of potential inconsistency or deviation from established policies, allowing for timely corrective action. Additionally, segregation of duties is crucial. By ensuring that different individuals are responsible for setting accounting policies, making estimates, and conducting reviews, the risk of errors or manipulation is minimized. This segregation also promotes accountability and transparency within the organization. Regular review and assessment of the reasonableness of accounting estimates, especially those involving significant judgment, can add another layer of control. This involves comparing actual outcomes to initial estimates and making adjustments as necessary. Lastly, the implementation of robust technology solutions, such as automated accounting systems with built-in controls, can provide an additional layer of assurance. These systems can help prevent errors, ensure consistency, and facilitate real-time monitoring of accounting activities. In summary, a combination of clear policies, ongoing training, internal audits, segregation of duties, regular review of estimates, and the use of advanced technology can significantly strengthen internal controls over accounting policies and estimates, contributing to accurate and consistent financial reporting. Ethical considerations related to applying IAS 8, such as managing pressure to manipulate accounting estimates or choosing policies that favor short-term earnings. Ethical considerations play a crucial role in the application of IAS 8. Particularly in the areas of managing pressure to manipulate accounting estimates and selecting policies that may influence short-term earnings. One primary ethical concern revolves around the temptation to succumb to external or internal pressures that might lead to a distortion of financial information. In the context of managing pressure to manipulate accounting estimates, it is essential to uphold the principles of transparency and truthfulness in financial reporting. For instance, there may be instances where management faces pressure to underestimate provisions for doubtful debts to present a more favorable financial position. However, succumbing to such pressure could mislead stakeholders and compromise the integrity of the financial statements. Similarly, the choice of accounting policies can impact reported earnings, especially in the short term. Ethical considerations demand a commitment to the long-term interests of the company and its stakeholders. For instance, selecting depreciation methods that artificially boost short-term profits might be tempting. But it raises ethical questions about the accuracy and reliability of financial information. To address these ethical concerns, it is crucial for the organization to foster a culture of integrity, where employees understand the importance of adhering to accounting standards and maintaining the highest level of professionalism. Establishing strong internal controls, conducting regular training on ethical conduct, and encouraging open communication about accounting decisions can help mitigate the risk of unethical behavior. Additionally, auditors and regulatory bodies play a vital role in ensuring compliance with IAS 8 and ethical financial reporting practices. External scrutiny helps maintain accountability and reinforces the need for accurate representation in financial statements. Ultimately, prioritizing ethical considerations in the application of IAS 8 not only aligns with the principles of good corporate governance but also contributes to building trust among investors, creditors, and other stakeholders. Upholding ethical standards enhances the credibility of financial reporting and reinforces the organization's commitment to transparency and accountability. Applied retrospectively case. In accordance with IAS 8, changes in accounting policies should be applied retrospectively in most circumstances. However, there are exceptions outlined in the standard. Retrospective application is required unless it is impracticable to determine either the cumulative effect of the change for all prior periods or the effect of the change on the earliest prior period. For instance, if a company decides to switch from a straight-line method to a more appropriate method of depreciation, such as the double declining balance method, the adjustment should be applied retrospectively. This means restating the financial statements of prior periods to reflect the newly adopted accounting policy. This ensures that the financial statements provide users with a comparable and consistent view over time. However, if determining the cumulative effect or the effect on the earliest prior period is impracticable, the change should be applied prospectively. Impracticability might arise in situations where the necessary information is not available, or the cost of obtaining it would be excessive. In such cases, the company should disclose the nature of the impracticability. In summary, changes in accounting policies are generally applied retrospectively to enhance the comparability and consistency of financial statements. But there are circumstances where prospective application is acceptable, as outlined by IAS 8. Retrospective application of an accounting policy change. The retrospective application of an accounting policy change involves adjusting the opening balances of assets, liabilities, and equity for the earliest prior period presented in the financial statements to reflect the new accounting policy. In other words, it requires restating the financial results of prior periods as if the new accounting policy had always been applied. This ensures that financial statements provide a comparable and consistent view across different reporting periods. For example, if a company decides to change its depreciation method from straight line to double declining balance, the retrospective application would mean recalculating depreciation for all prior periods using the newly adopted method and adjusting the historical financial statements accordingly. This approach enhances the comparability of financial information and helps users make informed decisions based on a more accurate representation of the company's financial performance over time. Correct errors retrospectively, and how should these corrections be made? When a company identifies material errors in its financial statements, IAS 8 requires the correction to be made retrospectively. Materiality is a key factor in determining whether an error is significant enough to warrant retrospective correction. If the error is material, meaning it could influence the economic decisions of users based on the financial statements, it should be corrected retrospectively. Retrospective correction involves restating the affected financial statements of prior periods. For example, if an error is discovered in the recognition of revenue in the 2020 financial statements, the company would adjust the 2020 financial statements to reflect the correct amount. This adjustment is made to the opening balances of assets, liabilities, and equity for the earliest prior period presented. The corrected financial statements are then restated, and any comparative information provided in subsequent financial statements, such as the 2021 statements, is also adjusted. In the case of a correction that impacts the income statement, the company would restate the affected line items such as revenues, expenses, and net income for each period presented. It's important to note that the nature and amount of the error, as well as the reasons for the correction, should be disclosed in the financial statements. This transparency ensures that users are informed about the correction and its impact on the financial information. Overall, the retrospective correction of errors aligns with the principle of providing accurate and reliable financial information for decision-making purposes.